Hey everybody, I'm EcoBuilder in the Hex community. I enjoy highlighting Twitter Spaces. Twitter Spaces is something that's been out for like 8 months or so. It's a feature inside of Twitter. It's called Spaces. Um, it's where there's like 12 microphones inside of one group. There's one host that organizes it. If they leave, everything's shut down. And so there's always a topic, a title at the top. You can pin tweets up at the top so that people can follow the conversation with examples. And so right now I have a replay of a conversation going on in my head that I'm wanting to share you. I mean, like literally to my ears. So I'm wanting to share this with you. So let's do it. And it's in a space by a person that I never have followed before. All right, let's go.
And if you want to finish what I'm going to say. So what, and again, I talk to Dr. Nas 3-4 times a week on and off Twitter. Okay. He's a friend of mine. So, I've never heard him say what he said today. And I was actually surprised too. And that was right at the time, Rahul, when my Twitter malfunctioned and I got put on the penalty box for half an hour there. So I couldn't ask him. I would have asked the same question, right? So now there's a couple things going on. Okay. So for one, he said demand destruction is permanent.
Right.
And he said, right. And what was the other term that he used for
Decline.
Decline, right? So now again, so much of what happens on Twitter, okay, is coming from places that are just frankly flat out incorrect. And a lot of people on this call may say that I'm incorrect about my ESG analysis, right? So like for example, you have a whole goon squad, okay, of wackos, right, promoting oil stocks every day. And if anybody says anything about, one thing or another, they pounce on them and this and that, just like the Bitcoin guys do, and just like the Tesla guys do. They're no different than those wackos, right? So,
Okay.
right, and they're all getting their information from one guy in Canada who basically is a stock promoter. Okay. So, and half of the charts that he posts on Twitter, Dr. Anas and I laugh. We talk on the phone and we look at the charts and we're like, gosh, it's just so bad, And then he tries to tell them to stop putting those charts up there, and the guy won't stop. So, so basically, demand for oil, okay, is within a 40-year range. So the supply and demand balance for oil is in a 40-year range. There is no catastrophic, issue with the supply for oil today. It's coming, right? It's coming, right? Because of all these policies, because of ESG and everything.
Right.
But as it stands today, there's not. Okay. And the wackos, the maxis, the shills, the bobbleheads, the pumpers, whatever word you want to use that are running around, most of them have never worked a day in their life in oil and gas. Many of them are unemployed. Many of them don't have any skills or qualifications to get themselves a job in oil and gas, right? The guys at the top there, okay? Right? So yet they're oil and gas gurus. Why? Because they're just taking information they're being fed. Most of it is just bullshit. What they've been saying is that the reopening trade, where we went from the lockdowns to the reopening trade, was going to spark a 2 million barrel a day increase in the demand of oil, and it just hasn't happened. Right. So if you look at all the data, and it's all on Dr. Anas's timeline, we've been talking about this for 6 months.
Right. Well, just to clarify, if I could.
There has been some demand destruction. There
Yeah, because
absolutely has been, you know.
the general demand destruction that I'm kind of inquiring, and I don't know if it's sourced from this particular group you're referring to. It's just the ambient noise I feel like I'm pulling in response to sort of why oil went from, say, that 130 to the 90, whatever's going on. But perhaps it isn't destruction, right? Perhaps Dr. Anas clarified this is demand decline, and this is, I guess, the heart of the question.
Yeah, so we would need Dr. Anas for that. So on Tuesday night, tomorrow night, once a week, Rahul asked me to come today over the weekend. I have my weekly Tuesday night 8 p.m. space. That's the one space I'm in every week, no matter what. All the rest of them, I just goofing around, or I jump on a space, or if Rahul asks me, or George Noble asks me, right? So Dr. Anas usually comes on that space for a few hours. But he's traveling, he's on vacation with his family. So I may be able to get him in there for 30 or 45 minutes tomorrow. I can assure you that this would have been the question I was going to ask him, but right when he was talking about it, my Twitter app fell apart, and Rahul couldn't see me for about a half an hour to get me back in. So this is definitely the question I want to ask him. So we'll have to wait till then if he comes in.
Okay, man. Well, I appreciate the time, and I appreciate the space, and
Hey,
it's particularly
let me interject real quick.
Javier's
Hey, buddy.
here. I didn't see you.
I wasn't going to speak
bro.
tonight. I wasn't
Yeah.
going to speak. I just want to answer this really quickly. One,
Oh, cool.
I've heard Dr. Anas's and chatted with him about his demand destruction versus decline, and he and I are in 100% agreement. So the term demand destruction is used rather loosely. There has been and I think you're trying to really nuance something that's almost irrelevant. The elasticity in oil response to price is pretty broad, right? A million barrels here, a million barrels there can be 30 and 40% swings in the underlying and also the product. A couple of things that we're seeing across the board. One, driving demand in the United States. I mean, people were talking about flat to 2019, plus 1% to 2019. And I think that when we end up at the end, after September and going back to school, I think we're going to end up looking at summer driving season that ended up at like 4% under 2019. That's a miserable failure. That is absolutely one of the most transparent views that we can use that the average person can see as driving demand. Airline flights, everybody's talking about how busy the skies are. We're still at like 70% of total flights. Industrial demand across the globe. So, and I've said this 100 times. We have a refining capacity problem here in the United States. And so there's this idea that there's this massive shortage of oil, which is just not true. If you look across the board at products all across the rest of the globe that are not gasoline and not diesel and not jet fuel, which is where the refining issue is, you've got other products that are all in bear markets. So you've got propane, butane, polypropylene, styrene, natural gasoline. We don't have structural bullishness on the rest of the barrel, and those are going to be industrial feedstocks, light end components, things that make plastic. When you see driving demand in the U.S. and industrial feedstocks and industrial components not in a bull market, you have to ask yourself why. That is where industrial demand, and Dr. Anas would call each of these price sensitive demand declines. If gasoline goes back to 99 cents a gallon, I promise you, people are going to drive in the United States. Unless the economic situation creates a situation where 99 cents a gallon is the same on a family's discretionary spend as $5 a gallon. So it's this giant, accordion of demand. Now, when he's talking about true demand destruction, he's talking about things that completely price themselves out of the demand never coming back. One of those things, and this is what 3 Aces is talking about. There's several people who keep pounding their chest about $250, $300 oil. If you break the system and you create a refining problem or a capacity problem at which we're at $12 a gallon diesel in the United States, you are going to create industrial and commercial demand destruction. That destruction is going to be shipping businesses that are out of business. It's going to be freight carriers that are out of business. It's going to be whatever steel and manufacturing businesses are left in the United States out of business. And if you think, and if I use it here because it's a general example, but we're starting to see it in Europe, and you're going to see, demand destruction this winter in Europe when they're fighting for natural gas. That's going to be different than incremental demand decline, which is going to be felt on the retail level and somewhat on the commercial level. True demand destruction begets a far more emotional response than a guy deciding he's not going to drive to Cleveland to go see his aunt because it's going to cost him, 3 times as much. It's a guy that can't physically put gasoline in his car. That's demand destruction. And I don't think we're quite there yet on a massive scale. Sorry to interrupt, Three Aces, but it was a great question. I am going to be on a flight tomorrow, but I hope Dr. Nas hasn't spoken because I want to hear him talk about it more.
Yeah, Javier, I didn't see you come up. I'm so glad you did. Javier is right up there with Dr. Nas. Javier is a commodities trader. He's been trading for 25 years. He trades the actual physical commodities, not these bullshit stocks, with 25% gross profit margins. Now, Isaac, just one other thing on the ESG side. The reason why I know it's China is because China is the only one who doesn't get criticized for any of the violations, right? It's China putting in a new coal power plant every other day. It's China using slave labor to make cotton for Walmart, Nike, and, Gap and the rest of them, right? China is the only country in the world who is not held to any kind of account whatsoever of what comes out of Davos, right?
No, absolutely. You and I would slightly disagree. I don't want to go down this rabbit hole because it's a bit weird, but I do agree with you.
Uh-oh, is it me again, Rahul? Did I lose the thing here with this?
I don't hear him either. I see Noble's here though. If George wants to come up.
Hey, George Noble. I don't know. Who else we got? We got a couple of people here. Blake has been trying to come up I've brought him up about 25 times and he keeps getting kicked back down. All right, Mimi.
Yeah,
Blake,
can you hear me?
you're not having a good day, buddy boy. You're not getting in.
I know. So it's
Yaba, what's up, my good friend? I see you there. Oh, there's Blake. Hey, Blake, what's shaking? Oh, he's having a problem too. Yaba, can you hear me?
Yeah, I seem to not be even able to see these requests right now as well. I'm
I
having a
don't
lot
see
of
any
problems.
requests either.
No, I see them all on my screen here. I keep letting them in and they keep getting bounced out. Obviously, Twitter's having the same problem that I was having earlier.
What about Yaba Daba? I think he's here.
Sandeep, Yaba's here. Yaba, can you hear me? No, it's saying.
No, I'm here. Sorry.
Hey, yeah, but did you have a question?
You guys are blowing out. You're blowing out Twitter. I think you're like 1,500 people in this.
We were up to 1,900 earlier.
Oh, Maron.
Then
Hey,
Twitter rugged us.
So, I've been listening. You guys, boy, you put me in a deep depression here. I have a couple on the lighter side of things, and back over to equities, which are, because the title of this Spaces is Recession ? We all by now have heard about Walmart Smiths, and explicitly they said that people are not spending money on general merchandise because they have to spend money on food. So we go back to our question, how long is inflation going to last? And I think all of us, or many of us, are thinking that it's going to last much longer than people thought. Gasoline prices, irregardless. One thing I did want to point out, just as a light anecdote, the VIX popped back above its 200-day moving average. Those of you who follow the equity markets, and I know there's mostly bond guys here, the bond market's 25 times bigger than the equity market. But as we've talked about the fire hose of earnings, this is going to really be an interesting week. And one of the things that I think is really interesting is that big oil I think Chevy and Exxon and I think it's Phillips 66 report kind of at the end of the day on Friday. So get ready for another fun day. But I believe Amazon was down 4 or 5% in conjunction with Walmart after the close. I'm guessing you'll see a sell-off and then tech will come out and save the day and talk about how groovy everything is. But as we were talking earlier about the advertising space, you start to see a drift off here, and maybe this happy little stock market isn't going to be so happy. Depending
Well, yeah.
again,
Yeah, but if I said to you, close your eyes, okay? Close your eyes, forget about anything that's going on in the world. For the next 12 months, interest rates were going higher. High yield bond spreads have blown out to 600 basis points, 400 to 600 basis points.
check,
Revenues were contracting.
check.
Profit margins are contracting.
Yep,
And earnings are contracting.
yep.
Right. And the S&P is trading roughly 19 and a half, 20 times earnings. Well, who the hell knows what that means? Because
Right.
forward. Okay. Right. So what would you do? Would
Well,
you go and load up on stocks?
I think Michael Kantrowitz kind of positions this question very well. I just want to say this. I don't want to go on. I'm just kind of getting bogged down in bonds and oil. But his right now growth has been outperforming value sectors. You got to look at sectors, forget about the indices. Where are we going to be going forward? And right now, when you switch away from inflation, the big, the $5 a gallon gasoline scene, to recession, boom, here comes growth stocks again. So here we are, and you've had consumer discretionary and tech, start to lift off here, but you haven't had financials, remember, yet. So now you're going to get this push me, pull you thing again. And I mean, I'm like, do I want to have my capital committed to something like that? I mean, that's my point. No, but remember that stocks, quote unquote, bottom 3 months before a recession is announced to be over. Well, hell, we haven't even announced that we're in a recession, whatever that means. We saw that jibber jabber today from the White House. So I just, again, I think it's crazy, and I think you got to be really, really careful, especially in a week like this, because if you get bearish, some positive news out of some of these mega techs, and man, you're going to be whipsawed hard. So again, just
Yeah. Well, I think the saying goes that the stock market bottoms when ISM bottoms, and typically ISM bottoms 3 or 4 months before the recession's over.
that's correct. Roger that.
Right. So all of the leading indicators for ISM are still 12 months, 14,
Yeah,
16
That's
months away.
that's the point. That's the point of my comment, my question when we talk about the topic of recession. Man, we ain't there yet. And people, people have this mentality of this groovy QE 2021 stock market. Hey, let's buy the dip, and no. Review the best people you've had on here. Listen to what they've said. Consolidate that into a thought train, and you're going to have these rallies. But boy, be careful, because I don't think we've begun. Nouriel Roubini, again, one of my, Dr. Doom. They used to call what's his name, Dr. Doom. But Roubini was on Bloomberg today talking about, man, forget about it. You got a big problem on your hand with these debt levels combined with recession. So just wanted to throw that out.
Yeah, I think me. I think we're going to see a debt crisis. Yeah. All right, so Yaba, sit there. Don't go anywhere.
Absolutely,
Hey,
absolutely.
Mimi, you had the hardest time I've ever seen anybody have getting into a Twitter space. You are definitely next. How can we help you?
Hello.
Hi there.
Hi. Thank you for letting me speak.
Sorry, Mimi, time's up. We got to go to the next speaker. No,
Oh my
I'm teasing.
gosh.
I'm teasing. Go ahead.
Oh my gosh. I just noticed something. I'm a numbers person, and I just noticed something. I noticed something about being over here in America. I just noticed that stuff sways here in America. And I'm talking about just the continents, oh, not the continents, but America. I noticed like if California have an earthquake, like we have earthquakes all the time. So when y'all talk about oil and all that, that's where we get our oil and stuff from. It's called like volcanoes and stuff. When you put people in there, they start to operate and try to control that. You can't stop stuff from coming from the earth. Is that okay? Um, I noticed that every time there's an earthquake in other countries, because I'm an American citizen, we've been paying to help other countries so much, and I get sick and tired of it. But thank you for the founding fathers that found where I'm from. We have all this good stuff over here. Um, it's just the people in charge. When you talk about stock or trade or oil or Bitcoin, that's what that is. That's simply what that is.
Okay, Audrey, you've been sitting there for a little while. Then I'm going to go to Larry. Audrey, do you have something for us? Okay, Larry, what's shaking, my brother?
I just wondered if I hear a lot of talk about like, oh, inflation is not dead, but like I'd like to hear like the 5-point case for 10% inflation a year from now. Like, does somebody have that case that they can make?
Well, I mean, again, remember something, okay? CPI, completely remove that from your mind. That 9.1 number is about as relevant as your high school math textbook. It's
Yeah.
useless. It's useless. Okay. For one, it's lagging, right? It's behind us. For two, what the Fed's looking at is the monthly number, not the year over year number. Right. So the monthly number was 1.3%. Okay, that's the number that you want to focus on, right? And then the Fed has come out and say, Powell said we need a series of declines in the monthly number. Now, to hit their 3% number, right? Their
You're saying
target,
3, right? Instead of 2.
It's 2, 3. They keep bouncing around to hit their 3%.
Call it 5, bro.
No, call it 3 just because it's easy math. Okay. So in order for us to be on an annualized 3%, that means that 1.3 number that we saw last week has to be 0.25, which is an 80% reduction in month over month CPI. Right? Right. So again, what's 1.3 times 12 months? 15.6. So we actually have 15.6 annualized CPI right now. Not 9.1.
Agreed. I'm agreed on that.
Right.
Yeah, for sure.
So now, if you look at what's driving CPI, principally speaking, it's rents and energy and stuff like that, food, right? Well, rents aren't coming down. The real estate market's not going to really get its ass kicked until we lose the labor market. The labor market's typically the last thing to go. Right now, what Cantro said tonight was we're starting to see claims increase. We've got 250,000 claims this month, which, is on an annualized basis or whatever he said is, back, 2018 numbers. So they're starting to inch up, right? So, on the other hand, what pushed gold up and yields down on Thursday was the Philadelphia prices paid number. Okay, it was down 18% month over month, which is a big move, right? But even then, that prices paid number, when it rolls over, leads the ISM by 18 months. So everything here, every single road leads back to, Q2, Q3 of next year. The recession being over, At which point, maybe, just maybe, we start buying stocks in the first quarter, right? So here, I just put in the nest now. If you click on the tweet, right, and blow up the chart on the left, you can see the monthly CPI number, highest on record, I think, 1.3, or highest on this chart. But if it's highest on this chart, I mean, it's got to be highest for decades, right? Because we didn't have any inflation, right? Okay, then you scroll over, it says a series of declining monthly readings, right? Then you scroll over again, it says inflation leading PMIs. Blow that one up. So this is basically prices paid index, which is the leading indicator for inflation. The CPI is the lagging. Prices paid is leading. Okay. So if you look at the chart, the blue line is ISM. Okay. Typically, the economy, the recession is over about 3 months after ISM bottoms. And that's when hedge funds and stuff, that's when investors start buying stocks, is when they see that. But ISM, if you look at the chart, historically, right? Because this chart now is pushed 18 months into the future. You understand? And then so prices paid is a leading indicator by 18 months. Right? So he advances it 18 months and inverts it, so you can see the correlations, right? So what this chart is saying is that when prices paid tops out and rolls over, right, it's typically 18 months from that day, roughly speaking, that ISM bottoms. Right? ISM bottoms typically 3 months before the recession's over. You following me? Did you follow that or no?
Aces, I think he
We lost him?
is back to listener mode. Yeah.
Uh-oh. What's up, Neely?
Hey. Hello.
What's up, Larry? Say, we're having a hell of a time here with this Twitter today.
Hey, Aces, I wanted to, excuse me just a moment. The clevelandfed.org website has inflation nowcasting. That is a really helpful site. Clevelandfed.org, it's inflation nowcasting. You can Google it. But for your CPI, your core CPI, and your PCE, which will be out later this week. And of course, everybody knows about atlantafed.org, the GDP Now estimate. Those two, simple free websites are very helpful in tracking some of this information. And that inflation nowcasting page on the clevelandfed.org site is updated daily. So
Can you send me a DM with that link, please?
I shall.
Thank you. Larry, what happened to you? Did you?
Yeah, I'm back. I got degraded to listener and then upgraded again.
Were you listening to me or no?
Oh, totally. Yeah. I'm still contemplating 10% inflation this time next year, and make the case or break the case is what I'm trying to get to. For all kinds of reasons, is a lot of people want to think about it, right? That's all.
Aces, can I hop in for just a second on this, on the math?
Of course, Neely.
Thank you. And I'm just recovering from, a 36-hour cold or something else, who knows? So shelter itself, which Aces mentioned, is about 32% of the overall CPI calculation. We peaked, I've got CPI data going back to 1913, and we peaked at about 20.8%. I think it was in the late or early 80s or very late 70s on shelter, off the top of my head. And if you were to just do the contribution math to that alone, that would get you almost 7 full percentage points, right, to a 10% number. So that's how it would be. Like what we're looking at here would be the shelter component, which, as Aces mentioned, Kantrowitz has also indicated this as well. It's empirical. Shelter lags by about a year. And so you're seeing all these, Case-Shiller home prices super high and what have you, like double digits, all-time highs, yada, yada, yada. Roll that forward next year. That is going to be largely the contributor, very likely, to CPI remaining elevated if they are reasonably honest with that for a shelter number. Does that help you?
Yeah, and I think we have Case-Shillers tomorrow, right? The new one.
Yes, I
Case
believe that's
Shiller's
right.
just a lagging index. I mean, there's nothing
The other
there.
point,
What
Larry,
are you going to learn from Case Shiller tomorrow?
the other point I would make to this too is to keep in mind that there's other housing related costs that are not factored into the CPI. There's 399 categories listed on table 2 of the release every single month. And one of them is like, it's not property taxes. Okay. So, and that can obviously range from municipality to municipality, but property taxes are also going up quite meaningfully. So whether or not we actually get a 10 print, next year, I think very likely it still might feel like a 10 print to a lot of households.
All right. Who's next? Sandeep or Aviator? Aviator, you've been there. What's up, Aviator?
Hey, what's up, fellas? I just wanted to say you guys are awesome. I can't think of anything that you guys haven't covered. Man, the FOMC, like, I don't know. I'm like all over this. Last week, Thursday, was a big meeting. This Wednesday, it's just going to be another meeting, but the basis points that they're trying to raise, and it's just everything trying to tame inflation. But one of the popular opinions that I heard was the labor statistics and the labor market. The people are low-key driving the country right now. So as long as people that are in the labor industry, they don't tap out, the popular opinion is that they're pretty much holding up the whole country. So as long as we don't tap out, like, yeah, I think we should be okay, because I think like with the last 25 basis points, I don't know if that's true, that was raised, and then if another 25 basis points were raised, like, that would just be excruciating. That would be insane. You'd see gas go from $5 to like $7 in a matter of weeks, and it's
Well,
just
I think
yeah.
this week you're looking at 75 bips, and September there's some, I guess, notion that they might go down to 25 bips, and I don't know. I mean, I think they may stay relatively aggressive, but I think we'll get some more data about that this Wednesday. But I see where you're saying, like, this is going to be certainly tough to digest these consecutive rate hikes. I mean, given the delicate economy we're in, but I really don't see them having a Fed put, given that even if unemployment rises to 5-6%, they may stay kind of hawkish because their main mandate right now is trying to kind of feed off this inflation and bring it down to a more reasonable level, which is really hard to do even with tightening, right? This is not a solution, nor is it a crystal ball. I mean, there's this false thought that this is going to solve everything. It's really not. It's almost like their backs against the wall because the balance sheet got out of control. They injected too much liquidity. And at the very least, if it doesn't tame inflation, what it will do is re-rate assets, right? Which it has done, except for housing. You've seen crypto crash. You've seen any unprofitable growth go back to reality. You saw what happened with Walmart today in terms of guidance. You saw what happened with Snapchat. And these companies are going back to levels that they belong at. And you're seeing a more normalized way of valuating companies, which is what it was before the pandemic and definitely before this liquidity boom we've seen in the past decade. So, while I agree with you that it is going to be tough for us to navigate, I am not a perma bear. I still own growth stocks. I do own many long stocks, and I am pretty bullish on our economy as a whole. But given the data and the amount of, I guess, fragility we have currently, given the different things going on in the world, from inflation to supply chain bottlenecks, still a global crisis kind of ongoing in Europe, which we didn't even discuss in depth. I know we covered a ton of topics, but with like nat gas and stuff, what's going to happen in fall, winter there, it's going to be pretty crazy. And those are 18 plus countries, right, in the EU. So, I mean, there's just a lot to kind of stir up. And I got some DMs, obviously most are positive about appreciating our spaces and our conversation. And some are like, well, everything's bad. Like, well, where's the end of the light at the end of the tunnel? And I mean, that's what we're trying to figure out ourselves, right? Make sense of this data, decipher it, be prepared to not blow up your account. And that itself is a light at the end of the tunnel, right? Because if you can survive to keep trading and you manage to come out of this, with more money than you left, or at least keep your accounts afloat, you'll have better opportunities when data kind of pivots or the Fed pivots, right? So that's kind of my response to some of the DMs I'm getting.
Guys, one of the most valuable lessons that I've learned in my career, okay? And I didn't learn it on Wall Street. I learned it in corporate America. It was taught to me. Doing nothing is doing something. Okay? You're sitting right now on a very, 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 very tenuous situation with all of these stocks now that are blowing up now. Okay, basically what that means is margin multiples are expanding for the market. It's now getting more expensive unless the market re-rates. This is going to be going on for 4 quarters. You've got the cost of capital skyrocketing, which hasn't even hit any of these companies yet. Remember, these numbers that we're seeing now from April 1st was the beginning of the quarter. That was like a whole decade ago already, the way things are moving, right? The shit show's ahead of us. You've got companies across the board experiencing increased cost of capital. You've got revenues declining across the board, for the most part, okay? You've got profit margins contracting, and you've got earnings contracting. Look at some of these companies, semiconductor companies are missing their earnings by 35% from their guidance, right? So, right, you're heading into a period of time. Some of these companies like Snapchat, they've pulled their guidance. They're unwilling to give the street guidance of any kind, right? So, it's what George Noble's been saying for 6 months. It's return-free risk, right? It's all probability. Nobody here knows one goddamn thing about what's going to happen. None of us, including me, right? I'm not an expert, right? But on a good day, right, the best we're going to be able to do is ask the right questions. And right now we're asking the questions. When does the stock market historically bottom? Well, it bottoms when PMIs bottom. When does PMI bottom? When prices paid rolls over 18 months later. Well, when did prices paid rolled over? Well, looked like on Thursday we had a rollover, right? All the data, all the statistics, all the probability and everything else is saying return-free risk, right? Let's see what a quarter. I mean, again, this isn't even going to be the ugliest quarter. This is just the beginning of the hike cycle. This is just the beginning of a lot of this stuff, right? We're going to be 2, 3, 4 quarters of this. So doing nothing is doing something. It's July. Go hang out on the beach, right? Let's see, we'll be on these spaces, off and on for the whole time. And when we start to see things change, we'll be the first to see it, but listening to some jackass on CNBC who's just repeating some bullshit that somebody told him. Remember, a lot of those guys you see on TV, they don't have a choice. If they're inside of a mutual fund or some sort of asset management company, they have to be long. They have to. That's their job. come hook or by crook. Either that or give their clients their money back, at which point they don't have a business. So what do you think they're going to say? Honestly, right? So what we're trying to do here is just give people some tools, and at the end of the night, the only thing that really matters is how you sleep at night, right? If you want to go long on margin and all the rest of it, great. If you can sleep like a baby, that's the only thing that matters. All right, Rahul, that's it for me.
I appreciate that, Aces. And, I think it's been a great session. We've gone on for about 5+ hours, and, we've covered a slew of topics, and we'll continue to do these sessions. I mean, it was everything I can think of. I think we covered it, from oil to inflation to PMIs to earnings to the Fed FOMC this week. We had some fantastic speakers on. I mean, go on my timeline so you can just give them all a follow. We had probably 15, 20 great speakers on over the session. Shout out to Aces, David, Special, who stayed on for majority of this and then kind of helped navigate it, and help co-host it. Aces has the spaces every Tuesday night. So, if you want to catch that, just give him a quick follow. Those sessions are really fun. Some great macro guests join, and it's always a good time, and you learn a lot. I do these pretty often as well, and I try to kind of keep my feed as educational and content that can hopefully help navigate through the data that we're looking at and talking about. So if you find this helpful and you enjoyed this today, feel free to drop me a follow, and you'll see our future spaces and kind of all the things I'm sharing around kind of the macroeconomics and tech and growth. And we do host oil and energy sessions as well with Dr. Anas. I know some people had some questions for him, which we couldn't get to today. He's been traveling, so I've hosted a few sessions with him. Aces, is friends with him offline and on Twitter. So we try to get him on these as well. So we'll certainly do one when he's available for a longer duration for all you guys. So again, the best way to keep up with this is if you give us a follow, you'll see the little purple blinky outside our profile to see we're on, and obviously tweets to set reminders and stuff. But yeah, no, I think this was great, and I'm hoping it helped people, and this is going to be a really big week. But I think there's still a lot more data and things to look at going forward. So I don't think this is the end by any means, but hopefully, we can see what we get and kind of make decisions based on what happens starting tomorrow with a couple of big tech earnings as well. You have all of the big five reporting this week from Google, Microsoft, Amazon, Facebook, and Apple between tomorrow and Thursday. So, like I said, tomorrow Aces has his spaces 8 p.m. I'm already committed to a couple as well. So I will tune into those and, of course, try to join the 8 p.m. one at night. David also hosts some as well. So drop him a follow as well. But appreciate everyone. Hope you have a good night. And I'm hoping this was helpful for everyone. Thank you.
Rock and roll, brother. Thanks a lot, Rahul.
Yeah, thank you very much, Raul.
All right, seems like that's it. They should end the space. That's pretty good. About 45 minutes live. Didn't put a dent in my computer use today. And I'm getting better at streaming stuff. So there were, like they said, 1,600, 1,900 at one point, 1,500 just a while ago whenever they mentioned it. These are probably patriots. All these people in here, you know what I mean? Okay, so the guy who was speaking that made it to where I went live with this, his name is 3 Aces. His handle is not a big deal 111. Sweet. All right, that should conclude this episode. Appreciate you streaming this. We got a comment from 730 Bang. I thought it was interesting too. I wish that I had caught more whenever I was out and about. I was hearing them And then once I got back to my house, then I started streaming it. But yeah, go give that guy a follow, or any of the guys a follow in there, if it is that you have a Twitter handle, and you'll be notified of the spaces whenever you're just roaming around on Twitter. All right, cheers.